You see a headline flash across your screen, a conflict happening thousands of miles away. It's easy to think, well, that's over there. It doesn't really affect me. But what if I told you that one single event could directly change the price you pay for gas next week, or what your groceries cost? That's what we're going to break down today, how these global shockwaves travel right to your front door.
And that's really the core question here, isn't it? This isn't just some abstract economic theory. We're talking about a direct line, a cause and effect chain that connects instability on the other side of the world to the actual money in your wallet. So let's trace that chain, step by step.
You know, the best way to think about this whole thing is like a ripple effect. Imagine a single stone, that's our conflict, getting tossed into a perfectly still pond. The splash doesn't just happen where the stone lands, right? The waves, the ripples, they travel outwards, growing wider and wider, and they end up touching every edge of the pond.
Okay, so to understand the ripple, we have to start at the epicenter, the spot where that stone hits the water. In the global economy, one of the most critical epicenters has always been the Middle East. Why? Because it's a massive choke point for the world's energy supply and a key artery for global trade.
Think about this number for a second. 1/5. That's how much of the entire world's daily oil supply has to squeeze through one single narrow shipping lane, the Strait of Hormuz. We're talking about 21 million barrels of oil every single day. It's not an exaggeration to call it the jugular vein of the global energy market.
So it makes sense then that when that choke point is threatened, we get our very first and most immediate ripple, a huge global oil shock. And this is where we start to see the real measurable economic damage.
And here's exactly how it plays out. The conflict starts, and that vital waterway gets disrupted. Suddenly, global oil flow doesn't just dip, it craters. The reaction in financial markets is, well, instant. From an analyst perspective, you'd expect Brent crude oil futures, that's the global benchmark, to surge by 15, maybe 20% almost overnight. That's just traders pricing in that extreme uncertainty.
Now that shockwave doesn't just stop with oil. It hits the global financial centers, New York, London, Tokyo, almost at the same time. And that brings us to our second ripple, the financial market reaction. There's a saying that just perfectly captures what happens next. It's this idea that when things get uncertain, capital doesn't just walk to safety, it runs. Fear becomes a much more powerful motivator than greed, and that fear triggers a massive, incredibly fast shift of money around the world.
So what does that run to safety actually look like? Well, here you go. Money just pours out of things that are seen as high risk, like stocks and corporate bonds. And where does it go? It floods into what are called safe haven assets. So we'll almost always see gold prices spike and a huge surge in demand for the perceived security of U.S. government bonds.
But look, this isn't just a digital thing happening on trading screens. It has a real, physical impact on the movement of actual goods. Our third ripple is all about how the entire system of global trade comes under enormous pressure.
Just look at the difference here. The cost to insure a giant container ship going anywhere near a conflict zone absolutely skyrockets. We're talking about war risk insurance premiums that can jump by more than 500%. That massive new cost basically slams the brakes on trade. Analysts estimate it could cut trade volume through that area by as much as 30%, forcing ships to take longer, more expensive routes.
So we've seen shocks to oil, shocks to finance, and shocks to trade. But now we get to the final, and let's be honest, the most important ripple, the one that actually washes up on your doorstep and hits your personal finances.
And this all brings us to that word we hear so much about, consumer inflation. It's pretty simple, really. It just means the rate at which prices are going up, which means your money buys less than it did before. And those global shocks we just walked through, they are a primary ingredient for inflation. And this is exactly how it happens. Those higher oil prices mean it costs more to transport food to your grocery store, and it costs more to make the electronics you buy. Those crazy high shipping insurance rates, they get passed on. Every single step in the supply chain has to absorb a new cost, and that cost ultimately gets passed right on through to you, the consumer.
So when you add it all up, every single ripple we've talked about combines to create this powerful current that just drags down the entire global economy. And the big question everyone starts asking is this just a temporary slowdown, or are we looking at the beginning of a full-blown global recession?
While this timeline shows you the potential and pretty sobering path forward. In the first 6 months, you get a clear slowdown from high energy prices and trade problems. If the conflict keeps going for 6 to 12 months, we start facing the risk of stagflation. That's high inflation and stagnant growth.
But if that crisis drags on for more than a year, well, according to most economic models, the probability of a really painful, multi-year global recession jumps to over 60%.
So really, the key takeaway from all this is that our modern world is just so tightly connected, so interwoven, that a problem in one part of the world can quickly become a problem for everybody. No economy is an island anymore.
Which really leaves us with one final thought. After seeing how these economic shockwaves travel across oceans and borders, and how they end up impacting every single one of us, is it really possible to say that any major conflict, anywhere in the world, is ever truly just a local issue?